to the GAAP net income profitability. On the call, Karp said, look, we are trying to be very fiscally responsible. The CFO also said we really care about GAAP profitability. One of the things I think maybe you two don't know about yet is they got to GAAP profitability because of selling out of some of the SPACs and because of $14 million they gained in interest on their cash reserves. That's what pushed them over the GAAP profitability EPS. But their actual revenue from operations is not yet GAAP profitable. So they maneuvered financially a way to become GAAP profitable on an EPS basis, and they are kind of guaranteeing us that we'll figure out the revenue side of it and the margin side of it to actually truly become profitable in 2023. How did you guys feel about the focus on this?
And that's why I like free cash flow as a better metric of profitability, because you can manipulate net income a lot easier than free cash flow.
I agree, but at the end of the day, the street wants to see positive net income, right? So it's like
I honestly could care less how they generate that net income as long as they're able to generate it. Every single company right now is the same position. Google has $100 billion in cash right now. $5 billion a year is probably just going to be interest that they're going to be collecting, which is good.
It doesn't matter. Of net income is dollar net income. Doesn't matter where
exactly. Exactly. So I think right now their cash hoard is good. What's good is they're not burning through the cash hoard to try to make investments in order to grow revenue. That's the key right there. Where imagine right now, like the whole SPAC debacle, imagine right now you have to constantly keep writing off losses on SPACs. You know, that literally was one of the things that held them back significantly last year, and that's not holding them back now. So hopefully that whole episode has been put to rest. I do, however, think that Sham may have been pushed a little bit to the side and saying, look, you focus on product. Don't worry about the business. Because I think the SPACs were Sham's idea, but I can't 100% guarantee it, right? Because if you look at Ginkgo, and he's a board member on Ginkgo, they do the same shit over there where it's like, oh, we'll invest in a company that's going to develop a product that we do research on, and then they'll pay us to do it. But it's like, you're paying them to pay you? Like, you know, so like I said, even right now, Sham not being on this call, you know,
that was interesting. What did they say? They was like he's in the dungeon somewhere. So he's doing some other stuff or something.
Yeah.
That was interesting. Steven, what were your thoughts on this GAAP profitability stuff?
Look, it's good. No matter how you look at it, it is good. It is positive. Hopefully they continue to generate it. I'm still stuck on their adjusted free cash flow and their cash flow from operating activities. I'm still looking at these numbers, and I'm not liking the year-over-year decline in it, even though we are net income positive, and that's what the street wants to see. Revenues increasing, you would like to see cash from operations going the opposite way, not declining. So I'm hoping fiscal year 2023 proves that 22 is an anomaly.
Why? Okay, so can we talk about I want to ask two questions. A, how important is it that they have no debt and they're still being able to grow? But B, why are their adjusted margins decreasing?
Well, no debt and being able to grow is incredibly important because you're not tapping the debt market to grow. You're growing truly organically, which is phenomenal because you don't have a leveraged balance sheet. You know, you have companies out there that grow through leverage, and you have a 5x adjusted EBITDA to market cap ratio, and you're tremendously leveraged. Palantir is not leveraged, so that's phenomenal. You don't have to spend capital to service the debt. So huge. What was the other one?
Why are the adjusted margins decreasing? So
I don't know. I haven't gone through
because gross margins are still 82%. So I would imagine sales and marketing is
but gross is gross. I mean,
that's my point. So sales and marketing has to be cutting into the adjusted.
Yeah, because the gross is just cost of revenue being deducted. You got to look at all the other expenses, which I haven't done yet. But look, in 21, you had a 28% adjusted free cash flow margin. Now we have 11%. I mean, we generated $424 million in adjusted free cash flow in 21 on what was it, 1.6 billion in revenue?
1.5. That would have been profitable.
But that's probably I have to look at it further, but that's probably because they're spending more on SG&A, right? And that's what you need. You need to get your name out there.
Yes.
Like as much
Chris,
as
I agree with that, but explain how their cash flow, take free cash flow out of it because of what you just said. But the fact that their operations are not throwing off as much cash from operations as it did last year, and they generate an extra 400 million in revenue, that's concerning. And I don't have that answer because I just got home. And I need
Well,
to
yeah,
look through
because
that.
they're pushing down market. That's obvious. If they're pushing down market, they're going for clients that are not as, like, in terms of like operational profit, not as high as they normally would have had, right? When you push down market, you're not going to generate that much revenue up front. But over time, just like they said, it's going to eventually compound itself and you're going to have those revenues grow. Initial pilots, especially if you saw how, like, look at the slide where it said they grew, look at the total number of customer clients they grew that have $1 million plus of spend with them, right? Versus 5 million or 10 million that they had right there, right? 55 deals at $1 million. That is a significantly big cohort of clients. If they're able to convert those 55 deals into, let's say, 2 million next year, and then 5 years later, 10 million, those are huge things. One of the things I don't like that they're not doing right now, and maybe I don't know why, but they used to break down like on what level of cohorting that they used to generate more revenue. So if you remember, if you generated based on a 2018 cohort, how much did those cohorts be in 2020? And then now, if you look at the cohort that joined in 2022, by 2025, those are going to be maybe $5 million to $10 million, per year contracts if it's successful. So that's the question. How much of these smaller customers are they going to be able to convert to higher dollar, higher value, revenues in the future? And I think it's possible. One of the things that I've been stressing like crazy over the last year, and I know everyone gave me so much shit about it, was they need to push down market, get into as many doors as possible, screw the amount of money that you're going to get up front and be like, oh my God, we have so much operational cash flow. F that nonsense, get in the door and then figure out how to upsell them later on. Don't try to upsell them now. If you go in there with a sticker shock, hey, it's going to cost you $5 million. Most companies are going to say, hey, that's the door. See you later. We don't need you. You come in with a price point that's much more easily swallowable, especially during a recession. Guess what? If your product is that useful, they won't mind spending $5 million later down the road, maybe even 10 million down the road. But you need to make sure that you're pushing in with a price point that's attractive enough for you to scale in. And that's what they're doing right now. So yes, they're taking some hits operationally, but like I said, as long as their customer count keeps growing, that's what we want to see. We want to see customer count keep growing and hopefully accelerating and get to the levels that we see with Snowflake and see with the other major SaaS players out there.
Let's look at this comment in the chat. Amit, if it's the big institutions like options that move stocks, what's going to happen in the minds of big money now that Palantir is GAAP profitable and SBC looks to be under control? So let me say two things on this. SBC is under control, but it's not declining every single quarter. It was actually slightly up this quarter. It was insignificantly up, but it needs to really get a lot down, even a little bit more. So I'm looking for that in Q1 2023. Let's see how much more further down it can get. But from 840 to 120, that's a pretty steep decline over the past 2 years. In terms of GAAP profitable, again, they've got to have a quarter where they like actually get net income, where there's real money, right? So like we still have to see that, even though we're GAAP profitable on the EPS basis. But if big monies want GAAP profitability and SBC to be down, they also want to see some decent growth, 25 to 30%. Maybe institutions will be a lot more friendlier to the stock.
Well,
I think overall,
selling off.
Yeah,
it was up 21% before. It's only up. I say only, but it's up 15% now. So who knows?
It might be down even more with CPI tomorrow.
Yeah, who knows?
I think a lot more companies, especially funds, are going to be open to buying Palantir now that they are GAAP profitable and their net income positive. There's a lot of ETFs, there's a lot of mutual funds, a lot of hedge funds. They do not touch your product or your company if you're not net income positive. That's like a guaranteed, we're not even going to look at you kind of scenario. Guess what? Now there's going to be probably a slow trickle of hedge funds, PE funds, everyone saying, hey, wait a second, they're generating cash. They're generating their net income positive. How long have they been net income positive? Let's take a look. Let's deep dive into who they are and see if we can open a small position that we can add to in the future. This is a classic example of Salesforce. They have the same trajectory that Salesforce had. So in 10 years from now, when you look back, you'll be like, wow, they consistently grew the last 10 years at 25 to 30% year over year. And that's what
And
you want to
keep in
see.
mind, this
Yeah.
is not an overnight investment. This is
Yeah.
not a short-term investment. This is exactly what Chris said. This is a 5 or 10-year investment. And Palantir needs a very strong 2023 to finish 2023 net income positive and to continue and hit that 30% growth mark. And I think you're going to see a lot of analysts come around. I think you're going to see a lot of funds start coming around. This quarter is great. It's a pivotal point. Chris said that before. We just need this to compound and continue happening through 2023. You look at the deal that they kept talking about with BP, 9-figure deal on the twin turbine. That's huge, especially since we know Exxon's a customer, especially since Kinder Morgan's a customer. And some of these other numbers that are in the presentation, and Chris, I don't like that Karp did not put the cohort slide in the letter. He usually puts it in his shareholder letter. I don't know why he didn't. It's one of the most important slides that they put in every year. But what they were talking about, the U.S. military and the Army, there's a lot of good things to hope for this year. And if they can keep these numbers of growth up with commercial and government, and if international isn't as slow as it was in 2022, they really could be sandbagging by a great deal in 2023. But
That's what I'm thinking.
We won't know that till the summer, though. You're going to need at least 6 months of data to even see if they're sandbagging.
The other thing is in a bad macro, 2022, they were able to grow pretty decently, get to GAAP profitability. I don't think 2023 is a bad macro yet. I mean, we still need a couple more months of data, but I mean, so far, this whole collapse S&P to 3,200, that just hasn't happened, right?
Yeah, but a bad macro is good for Palantir because companies are looking to do more with less. And if they need to implement different softwares to achieve that goal, that's what they're going to do. So
absolutely,
a bad macro really doesn't mean much for Palantir.
Yeah, I agree. Yeah, because they've been able to perform in a bad macro, and in a good macro, it might be even better for them. Or it might be a bad macro might be better for them as well because companies need to save costs.